Hello everyone and welcome back to Raise Your Wealth. In today's episode of the ASX ETF Profile Series, we're going to be taking a look at the Betashares Australian Sustainability Leaders ETF, better known by its ticker name of FAIR. We're going to be taking a look at the methodology behind ESG screening, what the ETF actually holds in terms of companies, as well as checking out some key metrics like fees and performance before giving my final thoughts. FAIR is a domestically orientated ethical investing ETF. Much like its globally orientated brother ETHI, which I've spoken of before, it seeks to provide investors with a means to invest in companies that align with the increasing awareness of environmental, social, and governance principles. These largely subjective qualities are an area of increasing concern, especially as climate change becomes more evident around the world. As a result, many of Australia's most prominent companies are absent from this ETF, giving a selection and allocation that looks very different from the standard ASX 200. So let's take a quick look at the methodology of the ESG screening for this ETF before taking a look at the holdings themselves. The FAIR ETF tracks an index known as the Nasdaq Future Australian Sustainability Leaders Index. In order to be included into the ETF, companies are subject to a multi-tier screening process. Initially, companies are subject to a negative screening. This means that companies that are invested in fossil fuels are excluded, or at least severely curtailed. The screening is then expanded further, ruling out industries like gambling, tobacco, armaments, and nuclear energy, just to name a few, the rest of which I will put on the screen for you now. Companies are even removed if they are deemed to lack adequate gender diversity on its board of directors. From this select list of remaining holdings, companies designated sustainability leaders are given preference. To be considered a sustainability leader, a company has to meet one of the following criteria: 20% or more revenue from an activity such as renewable energy, recycling, healthcare, animal health, healthy food, social infrastructure and services, community and regional banking, and sustainable forestry, to name a few. Honestly, this list seems pretty open-ended, and I could see many companies meeting the above criteria. Alternatively, they could receive either an A or a B grade from a trusted ethical consumer report, or they could become what's called a B Corp, which is a designation given from B Lab, a non-profit which gives the grading based upon governance, transparency, environment, and social standards. Obviously, the above screening is not foolproof, and there are some questionable companies that slip through the cracks. In addition, the very interpretation of what constitutes ethical company can differ from person to person, but it does serve to stamp out some of the worst culprits and on the whole make things a lot more sort of what most people would consider ethical. But now that we've got some idea as to what the screening process involves, let's take a look at some of the companies and composition of the ETF itself. I will place the top 10 listing for the FAIR ETF companies on the screen for you now. As you can see, the index has none of the big four banks. Also notably absent are the mining giants BHP and Rio Tinto. This gives us the following top 10 companies: Xero, ResMed, Telstra, Brambles, Sonic Healthcare, Goodman Group, Suncorp Group, Fisher & Paykel Healthcare, CSL, and Cochlear. You probably recognize at least a few of these holdings. Xero, for instance, deals with accounting software. Telstra deals with internet and communications, as well as keeping people on the support line for 2 hours, only to be told to unplug their modem and replug it again. Brambles deals with logistics, and principally they deal with a lot of the ship pallets and shipping pallets that go interstate and overseas. And if you go to the back of any shopping center, you're probably likely to see a few big blue pallets, and that's them basically. You have Suncorp Group, which deals with basically insurance for the most part. And then you have CSL, which is a very large and very prominent biotech company, which deals with things like plasma donation as well as vaccines, to name just a few of their business interests. But with all that said, it gives us a far more well-rounded ETF compared to the ASX 200, which 5 of its top 10 holdings are banks and 2 of its top 10 holdings are mining companies. It is, from a sector point of view, very balanced. You have healthcare at the top, but it's hardly overwhelmingly dominant, followed by real estate, financials, communications, and information technology. And it is of note with this index, or ETF rather, that each year there's a cap of 4% per security. So what happens is, if a particular holding becomes overweighted, come rebalancing time each year, it'll be pruned back to 4%. There are currently around 81 companies in the ETF itself, so it does have a reasonable level of diversity to it, just enough to sort of make sure you have, yourself spread across multiple sectors. But with that said, now that we've got a reasonable idea of what this is invested in, let's take a look at some of the key stats and performance. The issuer for the FAIR ETF is Betashares. They are the ones who will buy all the underlying holdings that comprise this ETF, as well as issue units as part of an open-ended fund. The assets under management, net assets, for this particular ETF are 807 million, so there is very little possibility of this ETF being closed down unexpectedly. The total management cost for the FAIR ETF is 0.49%, so it is more expensive than some regular ASX 200 ETFs like VAS or IOS, but considering this is more of a niche fund and an ESG screened one, it's about appropriate for what it is. The dividends are paid bi-yearly, and the share registry is Linked Market Services. Dividend reinvestment is available and probably recommended for most people that are accumulating wealth, just so you can get that multiplicative growth and those extra units every time the dividends are paid out. The 12-month distribution yield on this is 2.9%. This is a fairly high dividend compared to many other ETFs. Australian shares often pay a greater dividend due to franking credits. Come tax time, a certain amount of franking credits will be issued depending upon the amount of tax a company has paid already, which is indicated by the franking level shown on screen. These credits will be issued to shareholders and used to help decrease the amount of tax that you pay. As this ETF is a locally invested one, currency hedging is not really a thing here, so you don't have to worry about whether you have to buy a hedged version, because no hedged version of this exists. And as for the performance, this one has a return since inception of 9.01%. It's not going to blow the doors off of something like NDQ or ETHI, but it is right in line with the ASX 200 average, essentially. And considering that many companies are excluded from this ETF and that certain criteria have to be abided to, it is fairly respectable, and it shows that one can have an ESG sort of bias in investing without having to compromise the returns. But with that said, I'll move on now to my final thoughts. I personally like the overall premise of this ETF. Although the ESG screening is not perfect and somewhat open to interpretation, it does screen out quite a few of the worst culprits with regards to environmental harm. Furthermore, the exclusion of the big four banks is something that I tend to favour. I do not mind being overweighted in certain sectors, like tech in the Nasdaq, but banking is not one of those sectors. For me, once this ETF is included in a raise custom, which hopefully comes soon, I will change my bank-heavy RARI for the fair ETF. This ETF is not for everyone, and your own unique financial circumstances and goals should always be taken into consideration. But for somebody seeking ethical investment exposure in Australia or just want lesser financial mining exposure, this may be worth some consideration. Those are my thoughts anyway. What are yours? Let me know what you think in the comments down below and we can start a discussion. If you found this informative or useful in any way, please feel free to like and subscribe. With that said, I will leave it there and say that my name is Rich and I will catch you guys in the next one.